Arispe Morales, welcome to the program.
Thank you very much. A pleasure to be here.
So Fitch upgraded Turkey's outlook from stable to positive while affirming the rating at BB-. The assessment cites stronger FX reserves, improved external position, and continued tight policies. So which factor mattered most in tipping the outlook to positive?
I think it's a combination of the factors you just highlighted, right? First of all, important to note that when we discuss the improvement on the external balance sheet in terms of reserves, for instance, or reduction in dollarization, as well as the phase out of the FX protected deposit scheme, we talk about in the context of reducing external vulnerabilities. This also takes into account, of course, that the current policy settings as such also support a reduction in the current account deficit compared to previous Turkey's performance as well as relative to peers. So I think that that's important to take into account. The second factor, of course, is greater confidence from our part that the policy settings in terms of a tight monetary policy, a supportive fiscal stance, as well as income policies consistent with reduction of inflation will continue to support further lower inflation and greater consistency ahead of the next elections.
And should the outlook revision be interpreted as a signal toward a potential rating upgrade in the next review on July?
Not necessarily. I think that what we are looking in order to see in order for us to take a view of a potential upgrade, first of all, is to have greater confidence that the policy settings, as I mentioned, in terms of tight monetary policy and consistent fiscal and income policies with that objective, will deliver a sustainable decline in inflation as well as a reduction in macro and balance payment risks. Of course, that's a call difficult to make in 6 months and also very difficult to make ahead when we have an electoral event potentially in the next 2 years. So it's about, when we think that potential risk of policy slippage have abated, as well as when we think also that this policy consistency, improved policy mix, if you will, is delivering further improvement in reduction of external vulnerabilities for Turkey, either high reserves or reduced near-term external debt repayment commitments.
And what do you see as the single most binding constraint preventing Turkey from achieving investment grade status?
Well, we are right now at BB- with a positive outlook, and that's about 3 notches below investment grade BBB minus, right? So I think that there's still a couple of steps before that. One of the factors, of course, has to do with developing a track record of consistent and credible policy mix to reduce inflation, which remains significantly above the levels where we have for peers that have a similar rating in Turkey. For example, for the BB median inflation for this year, and that's average inflation, we have 3.5, while for Turkey we're looking at 27%. And you know that as long as inflation remains high, it represents a vulnerability for the country in terms of unanchored inflation expectations, potential episodes of pressure on FX reserves or the exchange rate, as well, as potential risks towards, the predictability and investor sentiment as well. So that's one factor. The other one is just seeing a track record, whether, we see what we have seen in the past of political interference in monetary policy is being left behind, and we have much more, let's say, predictable and independent policymaking process in Turkey. And the third factor as well has to do with governance, institutional strength. And I think what we have highlighted is since the last time Turkey was investment grade, we have seen a weakening in governance as reflected, for instance, by the World Bank Governance Indicator. So reforms that are directed at addressing this issue and reversing this trend could also be potentially positive for thinking of Turkey's rating being at a higher level in the future.
And the report also underlines the increased level and improved quality of Turkey's FX reserves. However, it also points out that Turkey's external debt is still high relative to its FX reserves, and that the external liquidity is still weaker compared to the BB median. I want to ask, how much of a rating constraint does this pose for Turkey?
As we said when we discussed the improvement in the level of international reserves, it's about reducing the vulnerability. As you correctly point out, when we adjust the level of external liquidity in Turkey for near-term external debt commitments, we have to a level of around 100%, while for similar rated periods, 137. So it is a relatively weakness compared to peers. However, what we also note in the report is that we have a very, extended track record of Turkey, the sovereign, but also the private sector being able to access external financing, as well in periods where there was, let's say, increased political uncertainty or policy uncertainty. So I think this is very important when we think about these high external debt repayment commitments. We have seen Turkey being able to access external markets on a consistent basis.
And the last time you spoke to CNBC, to our London representative, Berfu Güven, weak monetary policy and high inflation were the two factors you cited as reasons why you haven't been more bold in your assessment regarding Turkey. So do these factors still pose the same level of risk for you, or do you see improvements? Also, how do you view the pace of Turkey's disinflation process?
On the first question, yes, it still continues to represent a constraint on the rating. As we discussed earlier, when we compared our projected average inflation for this year of 27% versus peers, it's multiples above that level, right? So that it's still, a constraint. And then the track record of monetary policy. I mean, it's important that Turkey continues to build a track record of credible and data-driven and a very, let's say, much more traditional monetary policy than in the past. I think that this is progress. However, as we discussed, there's still probably for us greater confidence to be have, especially ahead of the next electoral cycle.
And do you think Turkey's monetary policy is getting enough support from the fiscal policy for fighting inflation?
So there's been a question for some time, and last year we saw that looking at the fiscal adjustment that we have, reaching a small primary surplus and reaching, a 2.9 fiscal deficit, very, very much lower than what was forecasted even in the medium-term program. We see that there has been an effort to, to rein in spending as well as revenue performance, right? So I think that at this point, fiscal policy has been aligned with the objective of lowering inflation. We've seen some other measures being taken this year to reduce some of the impact from administrative prices or tax changes as well to support this inflationary process. The key, of course, is to what extent fiscal policy and income policy will remain aligned with monetary policy ahead of the next elections. And I think this is an important thing to see in order to make an assessment of how well the policy mix has evolved and how credible it is going forward.
Mm-hmm. And how does Fitch view the current state and direction of the Turkish economy? What is the biggest risk for the Turkish economy this year?
So what we have seen last year is that Turkey's economy has been resilient to a very, let's say, volatile and uncertain year, looking at trade policies, geopolitical developments, of course. Now, what we have also seen is that the economy has been resilient in terms, for instance, the performance of domestic demand, with consumption and investment demonstrating, great and expected dynamism, especially looking at, for instance, the third quarter of last year. Now, looking at this year, of course, we see a further rebalancing process. And the key in terms of just thinking about growth, for instance, performance, we expect a 3.5% growth for 2026. That's slightly below the 3.8 estimate that we had for 2025. And a key component of that, of course, is what happens in Europe as being the main trading partner, as being the main factor in terms of external demand, determining the performance of exports. So with all this still noise about additional tariff, geopolitical risk, it's important to see, to what extent the projected European recovery will also help Turkey's external demand and export performance.
And lastly, I want to ask, do you expect stronger foreign investment interests in 2026?
It is a difficult call. I think that what we know now is that what you have seen is that external financing has become available for Turkey, and the prices have been favorable for the sovereign as well as for other institutions over the past couple of years. Now, when we look at investor appetite going into the domestic market, it has been mostly in the form of carry trade of short term, although there's some pickup at the beginning of the year looking at government bonds and equity. And I think from our perspective, what we are probably looking at, similar to investors, is greater confidence, that there is a much more traction in the disinflationary process, that the policy anchors committed to this objective remain in place, as well as geopolitics do not necessarily or directly impact the policies, impact Turkey, sorry. In the end, we can all agree that the past few years have been very volatile and uncertain in geopolitical front, not only for Turkey, but emerging markets, Europe, and all the economies. So in the end, it's just how much faith, how much confidence you can garner in continuation of the program that has delivered lower inflation as well reduction in external vulnerabilities for Turkey.
Mr. Arispe Morales, thank you so much for joining.
My pleasure. Thank you for having us.